let's talk about the basics of options through the lens of the iron butterfly using a day trade. Okay, using a day trade.
Please subscribe to our channel. Happy trading!
So if we're going to go over here and we're going to look at this SPX, and this SPX is it's pricey, but this is a good example to show you what I mean regarding the basics of options using the iron butterfly. So when you're setting up an iron butterfly, you are buying or selling the at the money strike. The at the money is going to be this in this area. Just whenever you're thinking about the at the money, it's basically where the stock is currently trading at. So in this example, if you wanted to do the buying of the iron butterfly, what you would do is start off by doing the straddle price, right? You're buying the straddle, buying the at the money. So the at the money is basically the 41.75. So that's what I would choose is the 41.75. When you buy a straddle, you are betting that it's going to go past the amount you are paying. And so you're paying the 1870 here. So you need it to move at expiration. If you're going to hold it at expiration, it needs to drop more than $18.70 for you to win something at expiration, or go up more than $18.70 for you to be able to win at expiration. So you're expecting a decent sized move, a move outside of the expected move if you're going to just buy a straddle at the money. And so, but if you decide to butterfly it off, then what you're doing is you're selling some wings. So let's just say we decided that we were going to sell some wings 25 points up and 25 points down. So something like this. So this is creating the butterfly, the iron butterfly. So this is the body of the butterfly, and then this is the wing of the butterfly on the put side, and then this is a wing of the butterfly on the call side. Okay? And so now what you're doing is bracketing off your potential gains to the downside and your potential gains to the upside, and you're minimizing your potential loss, right? You have a less loss. Before it was 1870 or something like that. Now the most you can lose is the $15. It's not likely that's going to be the case. You're going to lose $15, but that's how it's set up. Okay? So in this example, you are paying $1,500 to make 1,000. That's the most you can make. But the odds on making that 1,000 is very small because it would have to pin right here at this price. So if we go over to this curve view, you'll be able to see what I mean if I go to this analysis here, and it's let me see if I can make this bigger so we can see this. All right, so there you go. So this right here is that it's the most you can, the most you can lose is if it pins right here. And if it pins right here, I was doing the most you can win, and because we're gonna, most of the time we're doing the selling of this, and I'll show you that here in a second. But in this case, if it stays where it's at, then that's where you can lose the 1,500. That's very, very small probability that's going to be the case, right? But if it goes down a lot, that's how you can win the 1,000, right? If it goes up a lot, this is how you can win the 1,000. So this is a iron butterfly that is allowing you to win, that you don't need a bigger as a move as you did with the straddle, right? The straddle, you needed an 8 at expiration, you needed an 1870. In this case, you need a $15 move to the downside or the upside for you can win on this when you do this iron butterfly. Okay? So let me break this down a little bit more. When you are the buyer of a call or a put, let's just start with the call. If you're the buyer of the call, you have the right to purchase. Okay? You have the right to purchase at the strike price, and that's here. If you're the buyer of the put, you have the right to sell at the strike price. So this is why if it goes down a lot, you can win, right? If it goes up a lot, you can win because you have the right at this 41.75 here. But when you're the seller of a put, as we are here, you have the obligation to buy the shares at the 41.50. Right? So that's where it stops. That's where you stop winning at, because this 41.50 is where you have to buy the shares at. And then on the call side, if you're the seller of a call, you have the obligation to sell shares to the buyer of an option, or the 4,200. And so that's where you stop winning on the call side, because now you had your right, and then you have your obligation here at the 4,200. So you stop winning at a certain level, you stop losing at a certain level. This is how these kind of iron butterflies work. So what we try to do most of the time is that we do the opposite of this, and we sell the straddle here and we buy the wings, right? So once again, this is the body, right? And this is the wing on the put side, this is the wing on the call side. And so if we look at this dynamic here, we go here and we look at the curve view here, you're going to see that now this kind of crowned has switched, it flipped. So this is where you can make the most here, the 1500, but that's not very high probability that's going to be the case because it has to hit there. It's basically have to stay at the 41 the 41.75 for you to do that. But if it stays inside of the $15 that you collected, then that's how you can win. So this is your win zone here. You would lose if it goes down too much, and you would lose if it goes up too much. You want it to stay inside of this range here. You want it to stay inside of this range.
Please subscribe to our channel. Happy trading.
Talk about how you can take profits or exit this type of iron butterfly. If you are the buyer of the iron butterfly, then when you're a buyer of anything, you really can't fix it. Okay? You really can't fix it because you're adding more risk usually because you're the buyer of something, you paid a debit for it, and then if you're going to pay for something again, then obviously that's going to increase your debit. If you're going to sell something, then most of the time that's going to increase your risk. Maybe you have a call on or a put on, and then you sell the call or a put to turn it into a spread, then that's going to reduce your risk and your potential max loss, but it's not fixing it. You can't win after that, right? You can't win after that. But if you are the seller of an option, you have some things that you can potentially do. I've been studying this a little bit, and it's not great with this iron butterfly, but it's definitely something that you can try to execute. So for example purposes, when we're doing this iron butterfly, we're trying to get out at 25%. So that's going to normally increase our odds. We want to take off at 25% because you at best is going to have a 50-50 shot. And then if you take off at 25%, maybe you can take that up to about a 60% chance of being able to win on these. But that just say you collected $15, what you can do to adjust it, if you just don't want to get out once you're down, let's say 50%, then you can decide to adjust this and turn it into what we call an iron condor. So what would happen is once you're down one of the sides, the market has moved 15 points to one of the sides, then what you do is turn it into an iron condor. So for example purposes, let's say, because we can't show too many legs, I'm going to show this side here. Let's just say that the market was going up, and what we wanted to do is buy this one back, right? And then I just say we wanted to sell this one and then open up another one like this, right? So you're just kind of turning it into, you like adjusting it like a condor almost initially, but this is going away, right? This is going away, and then this is going to, what you had was long strikes here. So let's say you had one long here. Well, now you sell two, so now you're going to have a -1 here, right? You're going to have a -1 here, and then this is going to be a new leg that you didn't have before. This going to be 1. Okay, so this is going to be the short call now. This is going to be the long call. So, and then this is gone. So the put side is going to be, let's just say, way down here because it went up. So let's say the put side is, just for example, I'm just picking stuff right now. It's like here. Well, now that turns into an iron condor because this is a put spread now, and then this over here is the call spread. So you turned it into an iron condor, and I just say initially you received $1,500, and you had to adjust this. And let's say adjusting this cost, I just say, for example, it costs $1,000. It could be less, right? Could be less, a lot less, but let's say it costs $1,000. Well, you still have a chance to make $500 here, as long as it doesn't go past the 4,200. So that's you still have risk, right? You still got defined risk because you have this long call here, but you have adjusted it, and you're basing your win on the amount of credit you originally received. So as long as you don't have to give all of this back, then you can win. So for example purposes, let's say you still had 500 that you can make, and then for some reason now you can buy it back for, let's say, $250. Well, you've won $250 after the adjustment. You won $250. So that's not bad. That's one of the ways you can do it. Obviously, you still have risk if the market continues to shoot up, but in this example, you're giving yourself some ability to still win, even though the market is jumped up. Okay? And so this is turning it into an iron condor, and and then once again you have the obligation to purchase, excuse me, sell shares here, because on the call side you're the seller of the call, and then you have the right to purchase here on that one. So that's why it's defined at that point. And then it'll be the same kind of concept on the put side, but that put side is going to be at a very low delta because the market has moved up significantly, and so you turn the iron butterfly into an iron condor. That's how you can potentially still win on the trade. When you understand the basics, how someone can structure a trade, something like an iron butterfly, and you can still understand it because you just break it down from the basics, right? You're the buying and the selling and what's happening, and then you should be able to know what's going on with the trade. Are they bullish? Are they bearish? Are they neutral? You should be able to determine that. Even though you do not have, let's say you're not on TastyTrade, and then I giving you all this stuff down here, you should be able to determine what is the trade. Is it bullish, bearish, neutral, and are you receiving a debit, credit, all of that, right? You should be able to determine that by just understanding the basics of the options of the legs that you're buying and selling.